Hello, everyone, and welcome to today's webinar, Real Assets, Real Impact, a deep dive into the power of Canadian private markets. My name is Wayne Byrd, and I'm the Chief Financial Officer here at Skyline. I'm excited to be joined by Scott Figler, the National Research Director at JLL Canada. Scott leads research at JLL, providing market intelligence and strategic insights across all real estate asset classes with a focus on economic and demographic trends. Thanks for being here, Scott.
Thank you, Wayne.
Today, we'll explore essential real estate asset classes and how they offer stability, downside protection, and long-term growth amid today's economic and geopolitical uncertainty. This webinar is an exclusive benefit for investment executive readers and organized by Newcom Media's Content Solutions team. During the webinar, you can write questions for us by typing them into the questions panel located in the control panel on the upper right side of your screen. After this webinar, we will be connecting with you directly to address some of your questions. So thank you all for joining us. Let's dive in. As we take a deep dive into Canada's essential real assets, let's explore how these sectors like housing, industrial, and retail have delivered stability and steady demand. Our first few questions will focus on the resilience of essential real estate and its ability to weather market disruptions. So Scott, can you speak to how Canadian real estate has historically delivered steady returns during economic downturns, despite occasional short-term price dislocations?
Yeah, sure. I think it's important. If I included a chart here, if you want to go to the next slide. This illustrates it pretty well. So Canada has a reputation for being a safe place to invest, and we see that borne out in real estate. When you think about real estate investment from a global perspective, as if you were a global, diversified investor, there's certain geographies that are more volatile. There's certain geographies that allow you to capture upside. There's certain geographies that are more stable, and Canada is definitely the latter. So if you look at this is just a chart showing annual returns for real estate, over a 20, 30-year horizon. And then on the right-hand side of this, you can see the average return for 3, 5, 10-year in the full history. So to give you an idea, Canada over the last 10 years has earned just under a 5% return. So that's kind of middle of the pack from a global perspective. But again, you don't have to worry about things like, volatile currency, political instability, things like that. That said, there's periods of dislocation in the market. So you can see in the early and mid 90s, annual returns were going to about negative 5%. They kind of bottomed out at that point. During the global financial crisis in 2008, 2009, we saw Canadian real estate returns fall just below 0%. Obviously much more insulated than what happened in the United States, and there's many reasons for that. It's a more a less risky financial system. It's a more conservative mindset for investing. So that really played to Canada's advantage in 2008, 2009. Then you go to COVID, where returns fell to about negative 4%. Obviously, it was an anomaly that year. But again, there were places that performed worse. In the last few years, we've seen returns kind of hovering right below 0%. And in 2025, we've actually seen positive momentum on real estate returns. So from a historical perspective, Canada has been, again, kind of middle of the pack. But what we're seeing today doesn't come close to what we saw in the 90s. It's the good news.
So at Skyline, we focus on essential real estate, multi-residential apartments, grocery-anchored retail, industrial properties, assets that meet everyday needs and maintain demand regardless of economic cycles. So with that, to what extent is Canadian essential real estate insulated from global economic shocks compared to domestic factors such as GDP growth and interest rates?
Yeah, well, I think it's important to just call out right now that no one is completely insulated from what's going on. It's we're living through something that's truly unprecedented historically. So just putting that aside, what I would say about Canada is that, generally speaking, there's a hierarchy of what we call in real estate the asset classes and their vulnerability to economic headwinds. the asset class that is most tied in with GDP is industrial, and that's because it's easier to build, but it's also because the leases are shorter. They're generally around 3 years. We generally see, like, if there's a recession, you're going to see vacancy go up in industrial first, most likely. Enclosed retail is a close second, again, to differentiate between grocery anchored retail and enclosed retail. So shopping malls are somewhat vulnerable because of consumer spending. The office sector is more insulated because leases tend to be longer, 5-10 years. But then on the other end of the spectrum, essential retail, so grocery anchored and multifamily, especially in Canada, people pay their rent, people pay their mortgages. It's a pretty reliable system in Canada. Even over the last few years, we really haven't seen a lot of mortgages in arrears. We haven't seen people stop paying rent really in significant numbers. But then the other asset class that I'll focus on right here in this chart is retail, what's going on with essential retail. So one of the reasons why the Canadian market is more resilient is because it's just a simple matter of retail space per capita has been falling for a long time. So this is happening because this is a per capita measurement. So obviously population growth plays into this. So as population growth has increased over the last few years, there's been less retail space to service that. So it's been an undersupplied market. But then also, if you think about all of the rental and condo construction that's happened over the past few years, a lot of that's happened on retail parking lots by many retail owners, and in a lot of cases been redeveloped retail. So we've actually seen a lot of retail space removed from the market. So this is one of the reasons why retail is sort of having a moment right now, and especially essential retail, so grocery anchored, pharmacy anchored, things like that, because it's just undersupplied relative to the growth in the population. And then on the next chart, I'll show you just a comparison how Canadian markets stack up to their U.S. counterparts. A lot of the cities that have the lowest retail availability rates, to be specific, 5 out of the top 7 are Canadian cities. And then if you look at retail rental growth, Ottawa ranks highest in North America over the past year. Vancouver is also up there, Calgary and Edmonton. So Canadian retail tends to be undersupplied. It also tends to be built in a smarter way around density. And if you've driven around the US like I have, because I'm from there, if you drive around the suburbs, you might drive 20 minutes before seeing, and then you'll see a shopping mall in the middle of nowhere. That doesn't really happen in Canada. Whenever there's a shopping mall built or a retail center built, it's always done thoughtfully, surrounded by population density.
So you alluded into it, got into the US. So with the current US administration's tariff policies disrupting global supply chains, has Canada faced a similar period of dislocation in the past, and how might this episode compare?
It's very hard to compare this episode to anything that's happened in the past. The impact is going to be unpredictable. There's going to be some good that comes out of this, believe it or not. It's not just a doomsday story. What I will say is, going through the past economic shocks, so global financial crisis didn't really impact Canada that much, again, because of a pretty robust banking system that's somewhat risk averse, that played to Canada's advantage. And I would say, during the oil collapse, 2013, 2014, that was kind of the next episode. That didn't really hit Canada evenly. It was much more of an impact on Alberta, Saskatchewan, moderate impact on the rest of the country. During COVID, it's hard to compare that because I think we're seeing very different dynamics play out. COVID was really, it really hit the office sector hard, and it hit enclosed retail. So shopping malls were hit very hard by COVID. It wasn't a few years until sales kind of rebounded to where they were at. And during COVID, industrial and multifamily and grocery anchored retail sort of became the darlings during that time, because we all realized that those are the asset classes that you sort of need in your portfolio to create that stability. Now, what's happening is it's a little different because the one sector where we've seen some softening has been industrial, interestingly. We've also seen some softening in the multifamily sector, but it's hard to tease out. That I don't. It might be in part due to tariffs, but that's also because of slowing population growth. Obviously, in industrial, we've seen a huge supply boom. So there's a lot of factors at play. I will say now that essential retail continues to be sort of the darling of the investor market, whether it's institutional or private capital. But I think it's important to keep in mind, and I put this slide in here just as a reminder, Canada is not going through this alone. There's a lot of countries that are being hit with tariffs. From a relative basis, Canada is actually fairly well positioned. So there's a lot of talk about tariffs and what's going on with steel and aluminum and copper. But what's important to keep in mind is that most trade from Canada to the US is still covered under NAFTA or CUSMA or whatever acronym you want to use, the North American Free Trade Agreement, right? So if you think about the effective tariff rate, which is basically a weighted average of tariff rates based on all products that are moving into the US, you look where Canada shakes out, it's about 2%. Oddly, next to Russia, which, nothing really makes sense these days. But I think this is important to take into account. And then, once the North America Free Trade Agreement negotiations heat up, and if there's an agreement, which hopefully there will be, I think Canada is doing the things right now to prepare for a more robust status quo. So investing in port infrastructure, investing in other types of infrastructure, focusing on building housing. I mean, I think Canada is doing the things that it's had to do for years, but it's now being forced to do those things. So if we're able to renegotiate the free trade agreement, that's going to bring back stability to the market. But then if Canada will also have made these investments in the interim, it will put the country potentially in a better status quo than it's been in.
Yeah, thinking about these episodes, for us, when we think back on the great financial crisis and remember that period very well, while some initial panic forced property prices lower, we believed strongly that in our positions, this crisis would be largely contained to the US. And we viewed this as a buying opportunity, and it provided us an ideal time to purchase some prime assets at a discount in the markets that we focus on. And many of these properties today remain stable assets in our overall portfolio. And how you initially started your response to the question is, we're not really sure where this is going to go. When I speak to our investors, I will say the only thing that we know of for certainty is uncertainty. And we have a lot of months ahead to still kind of chart and make our way through these uncertain periods. So let's get a little more specific and dive into the multi-res housing sector. As you noted, and as we believe strongly, it's an essential asset class where long-term demand remains strong, even as affordability challenges and supply constraints continue to shape the investment landscape. So recent indicators suggest the government is already falling short of its immigration rollback targets, with immigration expected to continue growing at a steady pace and many experts forecasting housing starts to fall short. Do you anticipate a persistent housing shortfall throughout the end of the decade?
So short answer, yes. And we've been very vocal about this. I think there's a lot that is happening. Some is in the government's control, some is out of the government's control. But we're definitely entering into a period of, I think in 2 years, we're going to be in a supply constrained environment right now. It's looking different, and I'll show you kind of what the present looks like, and then we'll speak a little bit about where we think things are going to go. So this is looking at population growth rates, and you can see this is across some of the major provinces in Canada. You can see we're sort of normalizing, right? And it's important to point out here that this isn't happening in a uniform way across the board. So even at a time when population growth is slowing, which is slowing, causing rents to fall, you still have outperformance. So that gray line that is kind of hanging above the rest currently is Alberta. We're still seeing Alberta with some of the strongest population growth it's had historically, even still. I would also put Saskatchewan into that bucket. We've seen a lot of migration into Saskatchewan. It's still kind of a leader in population growth. The other provinces, yes, we've seen it slow. we've seen this kind of weigh on rents, which is kind of the, it's a new thing for a lot of multifamily investors to see rents coming down in Canada. But I think it's important to kind of sort of zoom out of the real estate lens and think about it from a societal perspective. Like, this is the objective of, the government, is to kind of create, and what we've been talking about even within the real estate community, is to create supply. How do we create supply to create a more stable market? Because we also don't want to be living in cities and towns where rents are growing at 10% a year, because there's a lot of people who are going to be in a very vulnerable position from that. So I think it's important to keep that in mind, even on in a conversation amongst investors. But putting that aside, I think that what's going to happen is going to play out. Again, it's not going to play out uniformly across Canada. So if we're looking at housing supply today, so completions, a leading indicator of that is housing starts. And we're starting to see housing starts really kind of falling at a faster rate, or growing at a faster rate, depending on where you are in Canada. So this chart kind of illustrates that. You see at the higher end of that, Edmonton, Montreal, Calgary, Halifax, these cities are really doing a great job of creating that housing supply. Starts have been pretty strong. On the other end these are the places where, if I'm looking 2-3 years out, I'm thinking that these are the cities where we're probably going to run into some serious supply issues, because starts are falling at such a rapid pace. So Toronto, the GTA, Waterloo region, Vancouver, to single those out. And I would say, even kind of drilling into this, it's really a story about condos when you talk about slowing starts, because we have seen purposeful rental incrementally increasing, but really what's going on is that the condo market is really kind of seizing, especially in those three markets. But even still, in the current environment where we're seeing rental vacancy increase, it's important to keep in mind that, that long-term average for rental vacancy is around, just shy of 3%, call it. Most cities are still well below that. I think some might jump that line once we get the CMHC numbers later this year. But I think, 2-3 years from now, I think across the board in Canada, potentially with the exception of Alberta, I think we're going to see a return to falling vacancy rates and rising rents again.
So digging in a little deeper then, do you still see a more constrained supply building in Canada, despite the government's plan to double the pace of construction to almost 500,000 new homes a year? Is the government's policy goal realistic, in your opinion?
Short answer, no, it's not realistic. And I think even the government, CMHC, know that. I think it's aspirational, it's directional. So again, I like to explain the housing supply using these three metrics. So starts, under construction, and completions. That's sort of the timeline when you think about how supply happens. You have starts, and then they're under construction, and then they're completed. So housing completions, that bottom line, are peaking right now. Under construction, which is that light blue line, the amount of housing under construction has been pretty flat, probably peaked around a year ago. But if you go to starts, that yellow line, that peaked in 2022. So, and it takes, probably around 3 years on average to build some of the stuff that multifamily investors build on average. So if you extrapolate that out, if you have starts peaking in 2022, you extrapolate out, a 3-year build period, we are at the point where completions are peaking. So I think starting in 2026, we're going to start seeing housing supply fall again, falling vacancy rates, probably a return to rental growth, and that's probably going to accelerate towards the back half of the decade.
So with home ownership affordability still strained in Canada and supply deficit nationwide, are we entering a structurally higher rental growth market?
I do think we are. So, but again, we have to sort of, if you think about it on an aggregate basis, I do think we are. There's certain cities where I think, again, might be exceptions to that, and I'm looking at the prairies. So, and I'll tell you why. So this is a chart that's looking at, this is just a general measure of affordability. So housing price to gross income. So for example, in Vancouver, the typical household, it would take almost 13 months. I'm sorry, the typical household in Vancouver, their income is about 1/13 of the average housing price. So the average house costs 13 times the average annual household income. Okay. Other end of the spectrum, in Regina, the average house costs about 3.4 times the average household income. Right. So we're seeing population flows to these cities that offer affordability. Regina, Edmonton, Winnipeg has been a big winner. Saskatoon, Calgary. I would also throw in an area like Waterloo region, even though they're towards the higher end of the spectrum, because relative to Toronto, it is much more affordable. So the fact that we're still seeing a lot of population flows into these places, I do think those areas, depending on what happens, how supply shakes out, if they're keeping up on supply, then we might see milder rental growth. But in certain places, where like Toronto, where we've seen housing supply falling, we're definitely going to see a return to stronger rental growth. In Toronto, what we're seeing right now is probably, a 1 to 2 year anomaly where rents are falling, and you can see it here. Toronto asking rents peaked in 2023 at just shy of 3,000 on average. Now they're down to about 2,700. Vancouver has seen rents falling by around 8-9%. On the other end of the spectrum, Edmonton and Calgary, again, cities where we've seen continued population growth, but crucially, they've kept up on the supply side. It's not as hard to determine what's going to happen in those cities because we have seen rents continuing to rise, even as housing supply has been very strong. So it's kind of a nuanced response. It's complex how this is going to shake out in terms of rental growth. But I do think Toronto, Vancouver, Waterloo region, we're probably going to see a return to fairly strong rental growth as we move towards 2030.
Yeah, it's interesting. Those two charts, this one that you have on and the prior one, it's interesting for us here at Skyline. It's important for us and for investors looking at us and following us. It's important to differentiate between primary and secondary markets when analyzing rental dynamics. While average asking rents may be softening in some major urban centers, we're still seeing strong fundamentals in secondary markets where demand remains resilient. And at Skyline, we've consistently seen a meaningful gap between in-place rents and current market rents across our entire Skyline apartment REIT portfolio. The chart that's up here today, our average in-place rent is in that $1,560 a month range. So when we look at, we're focused on secondary, tertiary markets, it's very meaningful, and it gives us embedded rental growth potential, even in an environment where headline rent growth may appear muted. Despite the broader narrative of downward pressure in the rental market, we're continuing to capture the upward pressure driven by strong lease tradeouts in key secondary markets, limited new supply in the areas we operate in, and which always been our strategy since inception to today. It's focusing on well-located assets in growing secondary markets to position us well to benefit from long-term structural shifts in population and the affordability trends. I think these two charts are great demonstration of where our strategy fits overall. Which Canadian markets are showing the strongest fundamentals for multi-res investment right now? And what's your definition of primary versus secondary as I talk about secondary, tertiary?
Yeah, that's a good question. So I think it's a very subjective, everyone has their definition of primary markets. For me, there's, in real estate, we call them the VECTOM markets: Vancouver, Edmonton, Calgary, Toronto, Ottawa, Montreal. So I would say those are your primary markets in Canada. Secondary markets, I would call, generally speaking, 400,000 or 500,000 people to 1 million. So I would call Victoria a secondary market. I would call Winnipeg a secondary market. Hamilton, Quebec City, and Halifax I would put into secondary. Tertiary would be probably population lower than, call it 400,000. But again, it is subjective. To Wayne's point, we are seeing a lot of momentum in secondary markets because there's been a lot of interprovincial immigration out of your primary markets in recent years. Not that they're shrinking. There's a lot of international immigration coming into Toronto, Vancouver, Montreal, but those cities have seen a lot of people, kind of more established residents, leaving those cities to other towns that are nearby, where they can, again, get more bang for their buck. So Kitchener, Waterloo, Quebec City, even Halifax, which isn't close, but there's been a lot of migration from Toronto to Halifax. So those secondary markets have really benefited strongly. In terms of what markets are seeing momentum, I drew a little red box to show, to bring attention to those prairie markets, because if you look at this chart, what it's measuring is rental growth, annual rental growth, year-over-year change in in-place rents. And the leaders right now are Regina, Calgary, Saskatoon, and Edmonton. They're all continuing to see very strong rental growth, even if, for example, Calgary and Saskatoon, rental growth has come off from a 2023 peak. It's still outpacing the rest of Canada. And then you can see, other cities like Kitchener, Waterloo, Hamilton, they kind of shot up in 22, 2023 before coming down in 2024. And then on the next chart, another measure of momentum in the multifamily space is how much investment activity is there, how much buying and selling. And this is something that I find really interesting, because I should note that the 2025 figure is only halfway through the year, right? So if I should have drawn it better on the chart, but if you squint your eyes and you look really closely at Calgary and Edmonton, they've actually seen more multifamily investment sales than Toronto. And I can't remember the last time I've seen that happen. I was talking with Mike Betzalel, our multifamily lead, the other day. He can't remember the last time he's seen that happen. So really, it's Calgary, Edmonton, that we call West Golden Horseshoe. So that would be Kitchener, Waterloo, Hamilton, London, that area kind of in southwestern Ontario. We lump all those cities together from an investment perspective, just to show the trend in the greater region. Those are definitely the three areas where we're seeing a lot of multifamily investment. So again, those capital flows are following demographics, right? And that's what we're seeing.
Just all great points. Appreciate that. We as well are seeing the same dynamics of price stability in secondary markets, largely a result of more restricted demand compared to primary markets. And as many are aware, segments such as condos in primary markets are currently underperforming due to oversupply and inflated pricing. And fortunately for us, Skyline, we don't have exposure to those markets, and a positioning that has benefited our apartment REIT portfolio, since inception. So we've been a lot on multi-res. You got something, Scott?
Yeah, there was something that you said a few minutes ago that I thought was a really important point, and it's about kind of the value add strategy. And so I think this is an area where, when we talk about a moment where rents, the market is somewhat softening, but where it can benefit the real estate investor is, for years the issue that we were having was that there was no turnover, right? Vacancy got so low that no one was moving. Now the benefit of having ample supply is that renters have options. They're able to kind of seek out what fits them best, but also that leaves behind a suite. So we are now seeing a return to the value add strategy from an investment perspective. And that's something that, again, this benefits renters and owners, because for owners, it allows you to go in and potentially renovate a suite that you haven't been able to access for 15, 20 years and mark that suite up to market, right? So when you have a market condition like we're seeing today, that's how it benefits the investment world, right? And that was actually holding back multifamily investment sales for the last few years. Now we're starting to see more money flowing into multifamily, specifically because there's higher turnover.
Yeah, absolutely. That remark, that comment, it fits us completely, and it resonates across our entire portfolio. Our turnover rate is between 20 and 22% a year, which, when investors hear that, they hear, well, 22%, they think of a 100-unit building. That's 22 units in a year. That's less than 2 a month. But again, it's that momentum, it's that ability to take the rents up and then surface that mark-to-market gap that can exist. And again, it's that stickiness in those secondary markets. So we've talked a lot about multi-res here. Let's shift our discussion to the retail sector. And we'll look particularly look at essential retail like grocery anchored plazas, which has held up remarkably well and continues to attract strong investor interest, even as the broader economy faces some headwinds. So could you elaborate on the sector's return profile of retail properties and how they tie into the broader concept of Canadian essentials?
Yeah, no, absolutely. It's a difficult thing to sort of measure with data, which, as you can see, I'm kind of a data geek and I tend to speak over charts. The best metric on this is the Canadian MSCI RealPAC Property Index, which is a lot of pension funds and other private equity funds contribute appraisals to basically determine where values are going. The problem is that retail segment that you see is mostly enclosed malls, so it's not the best representation of retail as a whole, and certainly different dynamics from essential retail. But nevertheless, you can sort of see that retail returns, generally speaking, like putting aside the COVID years, retail tends to be sort of middle of the pack in terms of overall returns. Like it's somewhat bond-like, because again, it's more meant to be a stable source of income for investors. Whereas, I would point to like the downtown office segment is really kind of where investment funds might try to really kind of hit that alpha, or the last few years industrial, but that was sort of a historical anomaly. Retail has generally been about stability, predictability, cash flow, safe cash flowing investment. But something to point out here, which is why I put it up there, is even this chart where that retail line is mostly skewed towards enclosed shopping malls, you see the hit that retail took during COVID in 2020, then you see the hit that retail took when interest rates went up in 2023. Now we're at a point where retail is resurgent. So retail is now, I would say it's kind of the darling of the investment world right now, especially grocery anchored retail. I work closely with Matt Smith, who some on the call might know. He sits right next to me in the office. He sells grocery anchored retail plazas across Canada, and his phone is, he's on the phone all day, essentially. I can't get any work done. But investors are calling him up. There's not nearly enough product for the number of investors that want grocery anchored retail. On the spectrum of real estate asset classes, grocery anchored really is the dominant one right now. But even retail as a whole, including enclosed, is having a moment, and that's because we're seeing foot traffic coming back, right? We're sort of fully behind the COVID days. E-commerce sales have sort of stabilized. We all know that we need the bricks and mortar. A lot of retailers have gone to e-commerce, but as a supplemental strategy. They're not necessarily replacing their physical footprint with e-commerce, but they're using it to complement their sales. So a lot of people have realized that, and retail is again having a moment, but it also comes down to undersupply, which is what I was talking to before.
Yeah, absolutely. When I look at that chart and I see 2020 and I think of our Skyline Retail REIT portfolio, which is predominantly 80% of it is essentials based, being grocery, pharmacy, quick service restaurants. When we talk to our investors and think about it through that brief period of time, really on the whole spectrum of things, we did not see our returns to decline. They stayed steady, they stayed constant, because while the government initiated an economic shutdown, we still had to get groceries, we still had to get our prescriptions, and we still needed to go get a Tim Hortons coffee, albeit through the drive-through, we couldn't go in. So we still remained very resilient and strong. And we really stand that this sector stability and resilience it really underpins its attractive return profile, making it a core component of what we consider Canadian essentials in commercial real estate. So what advantages do essential retail assets over non-essential retail? What do they offer when it comes to stability, tenant demand, and long-term investment performance? Why is the essential retail segment more resilient during periods of lukewarm economic performance compared to discretionary retail?
So I would say two things. It's relatively more stable cash flow with a lower sort of CapEx weight on the balance sheet. So NOIs tend to be more predictable and stable than in other asset classes. And on the next chart, you can see this is a comparison just looking at Canadian REITs, which is really kind of the only place where you can get this information. This is looking at net operating income growth, obviously a key metric in the REIT universe. And you just see that retail is pretty steady the whole way through. And, the last few years, it's actually been outperforming the office sector. But, NOI is based on, revenues and costs. It's pretty simple. So, if you have a stable revenue base and it's not too capital intensive, it's going to be a stable asset class. You see kind of in recent years, multifamily is outperforming. That was mostly a result of abnormally high rental growth. But now multifamily is sort of coming in line. You see where we're at kind of in the last quarter. NOI growth in the multifamily sector has started to fall. It's because that revenue is falling off, but multifamily is a very capital intensive asset class, right? So yeah, that's how I would answer that. But the other benefits that essential retail provides, if you go to the next slide, this gets at it more specifically. So this is, it's just on the demand side, right? On consumer demand. So this is looking at all the different buckets of retail as reported by Statistics Canada. And I drew a little red bubble around the essential categories. So whether it's grocery, whether it's pharmaceutical, you see health and personal care, that's pharmaceutical products way towards the right. So over the last few years, despite everything that's going on, despite higher interest rates, we've seen those sectors kind of hold their own and then some. So even in a down market, even in a down economy, we do see growth in those segments of retail.
Yeah, that graph, that chart there, it completely mirrors our investment strategy, not only just with the basis of our core tenancies, but then echoes into our secondary, tertiary market focus. Our retail REIT portfolio has minimal exposure to anything other than those three. That really we have minimal exposure to the volatile discretionary retail categories, such as fashion electronics. I mean, this really does demonstrate what is our core focus. So I look at the time and I think we better get onto this final category. So the final asset class we're going to discuss is Canada's industrial sector, an essential backbone of the economy that's navigating shifting trade patterns, evolving supply chains, and changing consumer expectations. So, how are some of these shifting global trade patterns and nearshoring trends influencing the industrial output of goods and tenant demand in North America?
Yeah, so that's kind of the question that everybody has right now. And, Wayne, we talked about this earlier, a lot of it we're still figuring out. We don't really know for sure what this is going to look like. The best indication of how this is going to play out across Canada, I found this from a Montreal think tank that put together these maps that I think really illustrate it. So this shows, again, this doesn't I'm not specifically saying that these towns are sort of in any kind of danger, but I do think it helps you sort of see where the risk is concentrated. So this is looking at, if you take a certain city, Windsor, for example, what percentage of the workforce works for companies that produce for export to the US? That's essentially what this is measuring. So you can see a lot of the top cities in Canada that produce for US export, for export to the US are in Ontario. Windsor, Guelph, Waterloo Region, Mississauga, Hamilton. So we are seeing an impact in those cities. I would also say that there's some good things that are happening. We've seen some suppliers from around the world establishing a base in Southwestern Ontario to access US markets. For example, companies in China or Philippines that are subject to higher tariffs. So I think that's potentially an unintended or unforeseen consequence of how this is all going to play out. But definitely Southwestern Ontario is the region to watch for this. And then I have just a few slides that show sort of province by province kind of where you would expect the impact. it's usually kind of in the northern areas because that's where a lot of the commodity material is sourced. So British Columbia, the northern areas. If you keep going, Alberta, kind of those northern areas where oil is produced. We're talking about towns that revolve around one oil well or one lumber mill, where, if that shuts down because there's tariffs on softwood lumber, for example, you can imagine that workforce is at risk. And then the last one shows Quebec, where you can see kind of that northeast area. That's the aluminum belt of Canada. And then the eastern townships, Drummondville, Sherbrooke, that's where a lot of aluminum processing and manufacturing is done to sell off to the US. So, we see kind of where the risks are theoretically, but there's also going to be a lot out of this that comes out of this it's hard to predict. As I mentioned earlier, there's a lot of investments being made in port infrastructure, LNG infrastructure, that are going to be a tailwind.
So we'll move along here. How are changing consumer behaviors such as same-day delivery and Amazonification of discretionary retail, how's that influencing demand for logistics space and reinforcing the need for modern industrial facilities?
Well, obviously, in the years after COVID, you saw a huge surge in demand for industrial space. A lot of it was because of e-commerce, but you see e-commerce penetration sort of spiked in 2020, and it's been kind of, basically stabilizing around 6% ever since. So the impact of the Amazonification on real estate, it has not been that warehouses and retail spaces have been supplanted by e-commerce. It's been that e-commerce has complemented retail, but it's also been that a lot of warehouse owners have had to get smarter in terms of how they build their buildings. Power supply is a huge driver of tenant demand because of the need for robotics. We're seeing huge demand. If you go to the next chart, we're seeing a lot of demand for 3PL, which is that blue on the first sort of block on each bar there. 3PL demand has been strong. E-commerce demand has essentially, it's really kind of collapsed. But instead, a lot of those e-commerce companies are going through a 3PL. But we're also seeing a diversification of industrial demand, which you see, the last few years, that other category. So what this means is that industrial warehouses have to be built in a way that suits a wider variety of users. They have to be built with more kind of next generation specs. They need, a certain type of flooring that allows autonomous, robotic vehicles to go around and collect packages and collect boxes. So I would say that's the biggest impact. It's not, for a few years, it was actually the demand was e-commerce. Now it's more just how the world works and the way that warehouses need to be built to just kind of make an efficient operation. It needs to be next generation space.
Yeah, from us, we echo that completely. I mean, when we think about the overall perception that industrial is taking a hit from tariffs, strength in Canadian supply chain focused logistics is still very strong, and the occupancy rate in our industrial rate is above 98%. It's higher than the national average, and we expect leasing activity to accelerate. It's on that logistic distribution warehouse. Recognizing again time, we're going to kind of get further in here, looking ahead. So let's kind of wrap this forward. Looking ahead, how do you see the demand for Canadian real estate evolving over the next 5 to 10 years? Do you think cyclical demands look similar to what we've seen in the past?
So I think we're entering into, it is cyclical. I think what we're coming into is, we're in a soft market right now across different asset classes. Certainly, multifamily rental, we talked about it. Industrial, we've seen vacancy rising to a 10-year high. The office market has had its challenges. I think we're at a point right now where all these areas are sort of oversupplied or have seen headwinds on demand. Pretty much across the board, we're seeing supply kind of falling, everywhere. You go through all these asset classes and you can see, 2019, most of them were landlord favorable. You fast forward to 2025, you see a lot of blue, so tenant favorable, meaning rents are falling, a lot more supply, a lot more options for tenants. Where we see things going over the next few years is it's definitely going to skew more towards landlord favorable. And the reason is because builders are kind of slowing down their building across all asset classes. And to Wayne's point, this is a cyclical effect. This is how the market self-corrects. When there's a lot of supply out there, builders will stop building. So that gives demand time to catch up. We start to see a return to rental growth, and that starts feeding through into higher returns. When there's higher returns, that entices more people to build. So I think the next back half of this decade, what we're in for is a period of stronger rental growth, higher real estate returns, and then maybe 2029, 2030, we'll start to see a resurgence of development activity. But it's all, we've seen this cycle many times before, and we'll see it many times again.
Great, thank you. Well, 10 minutes left. I think we'll just kind of open things up for questions here. And if for those watching, if there's a specific topic you'd like us to expand upon, market trends, investment strategies, anything else, please drop it in the chat. We'll do our best to address as many as we can. But prior to starting our Q&A session, I'd like to update you on the following. For those tuning into the live webinar, we'll be applying to AAC, ICM, ICS, and the Institute for Continuing Education credits. We will send you an email alert when your CE certificate is ready, which you can take up to a month. CE accreditation is powered by CE Corner. Follow CE Corner on LinkedIn to learn more about the newest courses so you can easily keep yourself compliant. And this webinar will also be available on investmentexecutive.com within the next couple of weeks, so you can replay the webinar at any time. For those watching the replay of this webinar who could not tune in live, we will also be applying to AAC, ICM, ICS, and the Institute for Continuing Education credits. After viewing this recording, please visit CE Corner to take a quiz and earn your credits pending approval. So now let's get started with some questions. One of the questions that have come in is, I'll pose this to you, Scott. What are the ratios outside of NOI is important in assessing a REIT?
In assessing what was that?
In assessing a REIT from an investment standpoint.
Oh, I mean, I confess I'm not an equity analyst, but from what I do have a few friends who are equity analysts. So FFO, you want to look at your debt multiplier, to make sure a REIT isn't too over their head in terms of debt. I mean, I would say that's a big one over the last few years, because as interest rates have gone up, a lot of REITs are refinancing debt at a much higher interest rate. So their debt financing burden at the end of the day is going to be much higher. So you want to look at their debt multiplier. We look closely at their occupancy rates to see what's going on with those. I don't know, Wayne, you're the CFO. What would you think?
Yeah. Well, yeah, to bundle that and add a few more things is when FFO, so from those who aren't all up on the acronyms, that's funds from operations. And whether it's FFO per unit or whether it's the funds from operations payout ratio, that is something that definitely needs to be looked at and assessed in ensuring that the payout ratio is less than 100% and something in the comfortable range of 80 to 85%. That gives the REIT that buffer on anything that was unforeseen, whether it's an interest rate hike, whether it's insurance cost taking a lift up that has that protection. And you noted the loan to value, the LTV as well. That's something that investors should be looking at and assessing, is the LTV side. You don't want something that's overly levered. You don't want something that's in that 80, 85, 90% leverage side, something that's in that comfortable range in 45, 50, 55%. Those are really key metrics. When you did mention as well, Scott, when you talked about as well occupancy level is something that everybody should assess, and this goes across all of the REIT structure or the REOCs, real estate operating companies. The occupancy level is something that all investors should be assessing and looking at. And then as well, on the commercial side, the industrial and the retail, a metric that we like to talk to our investors about as well is WALT, weighted average lease term. And what is that turnover cycle? So when we can get a tenants in place for 8, 10, 15-year leases, that again is a great demonstration of tenant stability. Anything further you want to add onto that, Scott, or does that kind of cover that question?
You covered it. I would just say there was a slide in there. I mean, people might have it as a follow-up, but we did show occupancy rates for different REIT sectors. It might complement that question, but we could also move on.
So then another question is looking ahead. I would then be biased, so I'm going to kind of pose this question then at you. Where do you see the greatest opportunities for investment capital in the next boom cycle? And where are those capital flows likely to be concentrated, in your opinion, or where should they be concentrated?
Yeah, I'm a big believer in I'm not just saying this because I'm on a Skyline webinar. I'm a big believer in secondary markets in Canada. I wrote a white paper a few years ago, basically saying that Waterloo region in 10, 15 years is going to be considered a primary a core real estate market in Canada, because the population migration from Toronto west down the 401, I don't really see that stopping anytime, and I think it's going to accelerate as we talked about in this presentation. I think we're going to come in Toronto into a period of renewed higher rent growth and rental inflation as supply falls. So I think what's going to happen is you're going to start to see a lot of people again moving into Waterloo region. I just see that as a long-term structural tailwind. I'm very, very bullish on that whole area. I'm also very bullish on Halifax. I think that what's going on right now with geopolitically, you're going to see Canada really kind of focusing on its relationships with Europe, and Halifax stands to gain quite a bit from that, being a port city on the Atlantic coast. I think I'm also very bullish on office right now. I think if you think about the investor mindset, you don't necessarily want to go where everyone else is going. You want to find value, right? And I think there's a lot of value in office right now. It's been sort of, a lot of people have written it off as an asset class, but we're seeing trades at 50% of previous trades on certain buildings. So there's been a significant write down on value, but we're also at a moment in the market where vacancy has peaked, and vacancy is now going to start falling because there's no new office construction. So I think valuations are going to continue to increase in the office sector, and the window to get in might be soon to be closing because some of the institutional investors, some of the big institutional investors are catching wind. I mean, you saw KingSett buying up a building in Vancouver. The secret might be out on that. But I think investors who have gone bullish on office in the past few years potentially got in at a very low base and stand to gain a lot on that.
So I know there's a question in here that I don't know whether you're going to have the data for this specifically. Somebody is asking about what the rate of return for the past 10 years in essential real estate market within the GTA. Do you have those metrics?
I don't know. I mean, it's hard to get that stuff because the people who have that information are investors who don't want to disclose it generally, or appraisers who are legally committed to not disclosing it. So the best source we have for public information like that is the MSCI index. But again, that's mostly, I would say it's like 80% skewed to enclosed mall retail. Yeah. So it's hard to get at that.
Yeah, it is very hard to get down into focusing on essential only, and then of course the subset of GTA itself directly. I know, Skyline Retail REIT since inception. So we launched the Skyline Retail REIT in late 2013, and our since inception is a double-digit return. But again, it's focused on those secondary, tertiary markets, and it is on all essential, grocery, pharmacy, quick service restaurants, and banking. As we'll move forward, just to kind of wrap this up, and if anybody has any further questions, please type them out, and we will do our best to get back to you on those. So we're now at the end of the webinar. Scott, thank you for taking part in this and providing some great insight. I'd like to thank everyone for joining us today. We've covered a lot of ground, from the resilience of essential retail as essential real estate sectors like housing, retail, and industrial, to the long-term advantages of investing in private markets during uncertain times. What's clear is that despite short-term headwinds, whether it's interest rates, supply chain shifts, or trade policy, the fundamentals supporting Canadian real assets remain very strong. Essential real estate continues to demonstrate its value as a source of stability, long-term growth, and impact. I'd like to invite participants to fill out our brief exit survey as we value your comments and feedback. And again, thank you, Scott, for joining us today and providing great insight. Big thank you for everyone watching. Have a good day.